Hello and welcome to FT Markets in New York. A new month beckons. That means the focus of investors will be on Friday's release of the all-important US employment report. Joining me today to talk about how markets may react or may not react to Friday's data, and indeed some of the data we'll see leading up to Friday, is Tracy Alloway. Hi Tracy, thanks for joining us.
Sure.
So we're currently in a very low volatility environment, so I'm just wondering if we do see continued strength in the payroll data, can that actually shake up the sort of level of complacency that some people think we are seeing from investors?
Right, well, I think you're onto something there, and I think this week's number is actually more important than some of the numbers we've seen in previous months, because of course we had some very weak economic data in the US in the first quarter, which everyone blamed on the bad weather. So the question now is, if Friday's number comes out relatively weak, then that doesn't look so good for the weather excuse for the first quarter number. So people are going to be looking very, very carefully at Friday's data.
And also what's been interesting though is the fact that last month we saw a very strong number for the April payrolls. We saw 288,000 jobs created. That helped stocks. In fact, stocks have had a great month for May. It hasn't been sell in May and go away for stocks at all. We've actually seen the S&P close in record territory.
Right.
However, bonds took a very different view of that strong number and it continued to downplay and in fact seem to be suggesting that the weather, it's not just about the weather that slowed down the economy here in the US. There's something else going on. What do you think that is?
Right, well, that's a good question. If I knew, I'd probably be working at a hedge fund.
Right.
But given that, what you just said, I think everyone in the market is asking at the moment whether bond investors know something that stock investors don't. I think it's a sort of ideological debate at the moment. It looks like bonds are pricing in lots of low inflation. I don't know if that's the right answer, but certainly the discrepancy between the two markets right now is a major, major talking point.
So let's switch over to the sort of volatility question because it is abnormally low and it's not just low in equities and bonds, it's low across all the major asset classes, FX, commodities. What's driving that, do you think?
Well, a number of factors. I mean, it's pretty easy to pin it on investors getting complacent after, 4 or 5 years of super low interest rates right now. We have seen some indications that investors, at least in the credit markets, are beginning to borrow a bit more to finance their positions, take on a bit more leverage, which really indicates that people expect this low volatility environment, low interest rate environment is going to go on for quite some time.
I mean, how dangerous could that become over time then if the Fed continues to reinforce this message that they're in no hurry to raise interest rates? And we have low interest rates generally across the yield curve, and we see data that, while is okay, is simply not strong enough to sort of shake out the sort of complacency.
Well, I think it becomes a pretty worrying trend, and I'm pretty sure regulators are certainly going to be casting an eye on it. The danger you get is if everyone's leveraging up their positions, everyone's positioned for a low interest rate environment for a long time, everyone starts pouring into the same trades, and everyone is long, everyone is in the sort of same position. When rates go up, you're going to see a massive, massive unwind of all those positions, and if they've taken on leverage to take on those positions, then the effects just get amplified.
Well, on that note, Tracy, we'll have to see what happens on Friday with the release of the payroll report and whether or not this current climate of low volatility continues or perhaps we see a bit of a shake-up. Thanks.